Iron trades.
Okay, welcome to our next lecture, Trade Entry Mechanics, Pulling the Trigger and Timing Entries Without Regret. With all the lectures, the basic housekeeping, nothing in this coaching constitutes financial advice. All materials are for educational purposes. Lessons will be recorded for posterity, and coaching is a self-driven educational partnership, so no specific trading results are guaranteed as an outcome. With every lecture, we have the candlestick patterns at the front, which I encourage everyone to familiarize themselves with. Pick the ones that suit your style the most. We're not going to review all of them, but I would advise maybe half of these are useful. You definitely don't need to know all of them, but definitely you need to be able to know and read candlestick patterns. So, the anatomy of an A+ entry. And let's start with what really defines a high quality trade entry. So first up is context alignment. This means that your trade idea should fit with the bigger picture. Are you trading with the overall market structure, the session trend, and the flow of the volume? You never want to be shorting right into support or buying into resistance unless the move is confirming that it's going to break through. So in that respect, context is king. And as we've noted, the macro structure and the time frame, higher time frame bias will generally give you that context. Then we move to confluence. And this is where we start adding multiple layers of evidence. That's where it all comes together. And we think of this like we're building a legal case. Your entry needs a few of these, if not all of them, to confirm the elements of an A+ setup. So questions you should be asking yourself. Are we near a key level, like the VWAP, a recent gap, a visible liquidity shelf, or maybe a clean prior high or low? Is MACD showing a momentum shift, like a fresh crossover, or is the histogram growing in one direction? Is RSI supporting the story? Either is it trending strongly, or is it showing a divergence, or is it near one of its extreme zones? And finally, is volume confirming the setup? So is it spiking when the move triggers, or is it drying up into a reversal zone? These are by no means all the confluences. Everyone and every strategy has different combinations of things, but these are key ones. So liquidity, MACD, RSI, volume. These are key and core tenets that can be applied to pretty much any strategy. And even without a strategy, these are the core tenets of being able to read the chart, the tape, the setup. And then finally, what is the price action behavior doing? So that's the story that we're being told via the candles. Are we seeing rejection wicks? Are we seeing engulfing candles? Are we seeing fake out moves that are getting absorbed? So these are the final clues that we want to pull all these levels together before we're pulling the trigger and we're saying this is an A+ entry. Optimal timing entry. So we're going to talk about timing, which is where a lot of the good ideas fall apart due to execution. It's probably what I would say where most traders fail. It's one of the most difficult things to put together because everyone can understand theory, everyone can understand what is and is not happening, but the ability to execute and do is what separates a profitable and a non-profitable trader. And generally it separates 99% of people from 1% of people. So first off, we don't want to jump early. It's very tempting to preempt a move, try and time a top or time a bottom. But if the candle that you're watching hasn't closed, then you don't have confirmation on what's actually happening yet. Anything can happen up to the last second of a candle. So let the setup mature. And this could mean waiting for the close of a trigger candle or even a slight pullback after an initial move. So just a micro retest. On the flip side, we don't want to be late. If we hesitate too long and we enter after an initial impulse move and the impulse momentum is gone, then we're stepping into a potential slippage or reversal territory. And that's how we get chopped. So putting that together, we don't want to preempt and we don't want to hesitate too long. That's that skill set of just having rep after rep after rep, watching the chart, knowing when it's time to pull the trigger. We want confirmation candles to close, but we don't want to wait too long so that we miss the momentum. Next, we would have to consider the time of day. There are certain periods that are just better for certain types of execution. So the first 15 to 30 minutes of the market, these can offer big liquidity grabs, big fake outs. They often resolve into trends, but this is the high volatility zone where large institutions, a lot of retail is looking for quick wins. They're looking for repositioning from overnight trading and pre-market trading. And there's a lot of moves that are not indicative of what is to come. They're just happening based on volatility. The power hours, that 10 to 11 period, and the end of the day, 3 to 4 period, and this is all Eastern Standard Time. This is often the cleaner setups, and from here, this is where the structure of the day is generally formed and is a lot more predictable. And then finally, post-news moves or after economic data drops, these can offer really big opportunities, but you have to wait for the impulse shakeouts to happen. So we're generally thinking of FOMC, CPI, JOLTS, these types of impulse moves that we've reviewed before, where you'll generally have a huge impulse move in one direction before price maybe reverses the other direction. It could form an N shape with an up, down, up, or a down, up, down, or it could burst through one side and keep going depending on the data that's being dropped. But what we're saying is that if you try to preempt the initial impulse move, you're just gambling up or down, so you're coin flipping. And if you wait for after the impulse move, you can actually time an entry, and there's a huge opportunity after the first impulse. And then finally, as with everything, volume. So volume is the clock. If a setup looks great on price, but the volume is dead, then you should probably pass on it, because volume is indicative of what's coming and what is. Strong moves are almost exclusively backed by effort, and volume equals effort. So it tells you if the market is actually agreeing with the thesis of what's happening. Okay, entry techniques. I use I use these for ES and GC, which are the futures vehicles that I trade. GC is gold for anyone who hasn't used it. These are 4 entry techniques that I use regularly, and depending on the setup, they could be better or worse, depending on the way that your strategy trades. Some of these could be useful, some not, but it just depends how you're going through these. So these techniques for entering, limit order retest is an ideal one for when price has already shown its hand. And let's say it breaks a key level like the VWAP, or it fills a gap. We don't want to chase it. We want to wait for it to come back, retest that level from the other side, and then we place a limit order right at that retest. It's patient and it's clean. And we're going to have a look at this, what it looks like on the chart. Break and hold entry. So this one's for when momentum is hot. If price breaks through a key level, starts holding above it or below it, and starts printing a few candles in that same direction without snapping back, we can generally use a market order to enter, keep a tight stop below, and start following the momentum. Liquidity sweep trap. This one's all about timing. So we're waiting for price to run the stops through a key level, say that it flushes below yesterday's low, and then immediately snaps back with some volume. That's the cue that we look for. The market just cleaned out liquidity at a low level, and now it's reversing, and we would re-enter on the reclaim. And lastly, fading the edge. This works really well with counter range theory. So reversal patterns like a falling 3, which you can see on the charts at the start of this lecture. When you're near the edge of a range, maybe it's the point of control or the VWAP, and price shows some weakness with a wick or a failed breakout or drying up volume or some absorption, then we fade it, meaning that we enter into a position opposite the direction of the initial push, and as soon as volume builds into the rejection, whether it's short or long, then price will start moving with some velocity in the opposite direction, and you're able to exit with profit before the move dries up. So taking these 4 techniques over to the chart, there's a couple of examples just from today's price action. This is the SPY ticker, SPY. And the first one that we can see very clearly here is the limit order retest, the first one that we talked about. So right at the start of the day, keep in mind the time of the day that we talked about. This is that first half hour. So there's a lot of impulse moves, fake outs, things like that. So the limit order retest, for instance, on this first move, we're just going to zoom in. We're on the 1 minute time frame. We had price move down, And the reason I've highlighted this white zone is that it was a level that was being tested all through pre-market and was acting as a support. So this is the polarity zone that we're waiting to flip. That's where we're going to place our order on the limit order on the retest. So price breaks down through here. While it's down in this zone, we would be placing a limit order up in this area. And you would have that order sit there. As price came back up, we can see that our volume was fairly dry. There wasn't a whole lot in it. So we know that momentum is not huge to push it back up. Price would have come back up here. It would have executed the buy order, and then we probably would be running a stop somewhere in this area here. Luckily, price was unable to break this level. So what was once a support over here is now acting as the polarity has flipped, and now it's a rejection point. Your limit order retest starts, and then price continues back the other way, and it never makes it back to the stop. You end up all the way down here, you're able to exit. The exact same situation here. You've got this area highlighted is acting as a support here and here. It was able to break under, and then even though price did peak its way back out, it was a fake out. Now we're back under. So it's acting as a rejection point here. So after this candle back down, you'd be considering a limit order right here. As price came back up, you're probably setting your stop at the top of this candle. Order is executing, and then it pushes back down. So those are some really good examples from today's price action. Next, a liquidity sweep trap. That was the third one that we were talking about. You can see that price. This is the previous low of the day over here. I'm going to bring this down just so we can all see that. Price, huge liquidity sweep candle. It's come down very low, all the way down here. And we can see that volume was harmonic with that drop. And immediately, the buyers started stepping in. Now, the volume's not massive, but the seller volume drying up is what's key. You can also see that the RSI bottomed out and the MACD flipped over as well. So on this huge wick down, you can see that these wicks to the downside show that buyers are starting to step in. So buyers stepping in, and then 2 or 3 candles later, that whole bottom piece of this move has been absorbed. So up here, you would be looking to the top of these candles. Once the buyers have reclaimed and pushed price above, that's where you'd be looking to enter right here. So you've got liquidity sweep down, price refuels, reclaims this level, you enter long here, setting your stop probably at the bottom of these candles here, and then you just ride it all the way up. If I had the EMAs turned on, we'd probably be seeing, you can see exactly in that zone that I've just highlighted, that's when price reclaimed the 9, and then it rode the 9 pretty much all the way up to here. So you've got a good hour and a half of price momentum that you could have ridden on that long entry there. And then finally, one more good example from today is fading the edge. So we can see that this zone was set up earlier in the day at about 1 o'clock, and through the rest of the afternoon, price couldn't make its way back up there. And when it finally did, there was one long wick rejection candle here. So we know that this zone is a point of control. When price made it back to this finally, it wicked high, started to push low. You would fade in here knowing that the buyer volume is drying up. The buyer volume is actually getting weaker into this wick push. So you would be looking to enter short somewhere along this candle in this zone, and then you would have been rewarded almost immediately, and you'd be able to take the edge off. Considering it was the end of the day, there'd be high volatility and cheap entry prices. So this would have been probably a 100% move on 0 DTE options if you had faded the edge correctly there.
Iron Trades.